Home Depot stock is up by over 39% in 1 year. But if we look at the recent results, it just does not make sense. Revenue is down by 0.7% year over year. Net income is down by 4.4%. Cash is down by 57.1%, and debt is up by 21.4%. So why is the price going up? Well, the reason for that is a great long-term performance of the company and not the short-term results. Home Depot is a good, stable, boring company that attracts investors and not speculators. It just shows that we should not put too much emphasis on quarterly results, but instead we should look at the big picture. So let's analyze and value this company by looking at a 10-year horizon. If you were to invest $1,000 into Home Depot 10 years ago, you could buy around 11 shares, and now they would be worth something close to $4,336. And this company also pays dividends, so in that time you would get $512 as dividends. So if we add together the current value of shares and the dividends, we get $4,848. And that is a gain of 385% in 10 years. A very nice result. Individual insiders, that is an X, 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%. So the management does not have its skin in the game. And are individual insiders buying? That is an X. We unfortunately see a lot of sale transactions in the last year. And do super investors own this company? That is a check. There are 7 super investors that have their money in Home Depot, including people like Thomas Geithner, David Katz, Terry Smith, or Lee Ainsley. So some really big names. And are super investors buying right now? That is an X. In the last quarter, they bought over 14,000 shares and sold over 330,000 shares. So both insiders and super investors are selling. That doesn't mean that we should sell, but it is an indicator that they probably believe that the price is rather high. Return on invested capital. That is a check at 31.5% 10-year median returns. And we want to see this number higher than 10%. So that is a great result. The management is doing a solid job. And what do we know about net profit margin? It is a check averaging 10.3% over 5 years, and the industry median is 6.5%, so they have some pricing power. And now let's take a look at share buyback. It is also a check. They bought back 30.8% of their shares in the last 10 years. That is very good. As long-term investors, we own a growing portion of the company and its earnings without having to put any additional money into this investment. And what about the debt? It is an X. It would take over 3 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years, so it's a bit high. Revenue growth, that is an X at 6.8% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so not very impressive. Free cash flow growth, that is also an X at 8.8% in the last 10 years, so closer to the 10% we would like to see, but still not quite there. And earnings per share growth, that is a check at 14.9% in the last 10 years. And this can be mainly attributed to the fact that they are buying back shares. So nothing exceptional when it comes to growth, but not bad. The dividend yield is 2.1%, so shareholders can expect to get $9 annually per every share. And the payout ratio? That is an X at 59.2%. So it's a bit too high right now, because ideally we like to see at least half of the earnings retained in the business. However, it's probably not something we should worry too much about. And what about dividend growth? It is a check at 11.6% 5-year growth rate. So a very nice growth, and this dividend is getting bigger every year for the last 14 years. Price to earnings ratio is 27.7, so at the first glance it looks rather expensive. But let's use a discounted cash flow analysis to value Home Depot. So in the low scenario, we will estimate a growth of 5% for the first 5 years and then 3%. In the medium, 6% and then 5%. And in the high scenario, 9% and then 7% growth. So the low scenario is predicting that Home Depot will grow a bit slower than the home improvement market. Medium is showing a story in which they will grow just as fast as their competitors, and the high one is anticipating that Home Depot will continue to grow at a similar rate to what we saw in the last 10 years. So with such estimates, the intrinsic value in the low scenario is $201, in the medium $228, and in the high scenario, $285. But we have to always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $140, in the medium $159, and in the high one $199. And the current price is around $415. So it is all in the red. Home Depot seems to be really expensive currently. And if you would like to learn how to value any company by yourself, then go to stockinvesting.academy or click the link below and enroll to our company valuation course. So if we go to our Stock Ranking Pro and click the overview, we see that financial health and dividends are the strong points of this company. And that is not really surprising. This is a typical graph of a stable company that is taking good care of its shareholders and that is minimizing the risk rather than trying to grow at all cost. So we have a company that has a really nice return on invested capital, that is buying back shares and has a nice growing dividend. But unfortunately, it is expensive and its growth is a bit below our expectations. Also, if they are buying back shares while the stock is expensive, it may not be the best way to use this capital. So this is a situation in which we should know the valuation, understand the company, and just wait for the right price. It is a really solid business and we just have to be ready to pull the trigger. And actually, the stock ranking is a great tool exactly for such situations. Having all the data in one place allows us to always be ready to act. But we do it only when the price is right. Thank you so much for watching and see you in the next one.